In this video, I'm going to talk through all the tax office target areas this season. And I'm not going to only talk through the scary stuff. I'm an accountant, so I'm going to also talk you through some of the tax deductions you might be missing out on. Let's first talk about work deductions. What has changed in the tax office's approach from prior years is that they now use third-party data matching across platforms like rental platforms such as AirBnb, crypto, and the gig economy. They check the numbers in your tax returns to the information provided by these third parties. And the golden rules to claiming work-related tax deductions and avoid tax office scrutiny are these. The first is that the amount you have spent must be directly related to you earning income. And that tiny rule is where all good tax accountants earn their money. The second is you actually must have paid for the cost yourself and not been reimbursed by your employer. And the third is you must have good records and proof to substantiate the claim. Recent examples of spending that have attracted attention and do not satisfy those three golden rules are things like personal clothing, meal deliveries like UberEats, gifts, childcare expenses, and other costs that only have a limited connection to your employment. Now, what's really good is the ATO actually has a website that has guides for different jobs and different industries on some of the kinds of tax deductions that you might be eligible to claim to make sure that you're not missing out on anything. I'll leave a link to this in the description. And if you're the kind of person that throws your receipts in a shoebox or are really poor at keeping records, there's a multitude of apps you can use nowadays. Even the ATO has an app that allows you to save the receipts in there automatically so they're ready come tax time. Now, some tax deductions that people commonly forget about. If you pay for income protection insurance and you pay for that outside of your superannuation fund, the fees that you pay for that are generally deductible. Things like professional memberships and union fees, last year's tax agent fees, tools and equipment. If they're underneath $300, you might be eligible for an immediate tax deduction on those items, and work from home deductions, which I'll discuss next. COVID forced a lot of people to work from home for a period of time, and that habit has stayed in the economy to varying degrees. If you work from home for part of your employment, or you run a business from home, then you may be eligible to claim tax deductions, and there are two methods you can choose from. The first method is called the fixed rate method, and for financial year 2026, it allows you to claim 70 cents per hour you worked from home. Now, the tax office target area here is if you want to claim this tax deduction, you need good records. You need to keep diaries, you need to keep timesheets to prove the hours that you work from home. You don't have to submit these with your tax return, but you have to have them ready should the tax office ever request them from you. And this 70 cents covers a few things. It covers home and mobile internet and data, energy, electricity, and gas for heating, cooling, and lighting, and consumables such as stationery, printer ink, and paper. And be careful not to double dip and claim the 70 cents per hour as well as your internet bill. There are, however, a few things this 70 cents does not cover, which you can claim as an additional tax deduction in your tax return. Things like office furniture, desks and laptops. And if the item is $300 or less, you can generally claim an immediate tax deduction for that. If it's over $300, you typically have to claim that tax deduction over a number of years, and this is called depreciation.
So this year we're focused on three things: work-related expenses, working from home deductions, and omitted income. So we do see some funny claims. We had someone this year who tried to claim their engagement ring as a donation on their tax return. We had a company director claim their treadmill, juicer, coffee machine, I think their gaming console, and a bunch of other stuff as working from home expenses. Now, in both of those, they're private in nature and you can't claim them on your tax return.
The second method is called the actual cost method, where you actually calculate the tax deductions that you're entitled to. Now, sometimes this does result in a higher tax deduction than under the fixed rate method. However, it is much more difficult to calculate. As an example, to calculate how much electricity that your home office uses, you need to look at how much electricity each of your appliances use from your manufacturer or from your instruction manual. And then you need to work out your cost per unit of power from your electricity bill. And then you need to multiply those numbers while considering how much time you use those appliances for just to claim your electricity deduction. Much more time consuming. However, if you have quite a heavy work from home schedule and may pay to attempt to calculate your tax deduction under this method because it can give sometimes a higher tax deduction. For occupancy costs such as rent or interest on your mortgage, these are typically only deductible if you are running a business from home. So think things like your doctor or your physiotherapist that are running their own business out of their home. That's when those occupancy costs can be tax deductible. However, for an employee that's just working from home from time to time, generally you can't claim those types of costs as a tax deduction. Now, how can you use superannuation to reduce your tax bill? Now, this is a good tax benefit because it allows you to keep more of your own money and reduce your tax bill. However, the downside is that money is locked up, typically until you retire. Here's how it works. Let's first talk about salary sacrifice. So sometimes you can make an arrangement with your employer that instead of paying some of your salary to you, it's instead directed into your superannuation fund. So instead of it hitting your bank account and being taxed on it, it's redirected before it even hits your bank account to your superannuation fund. And your superannuation fund is typically only taxed at 15%, which is much lower than the personal income tax rates. Now, if you can't set this up with your employer, don't stress. The money can hit your bank account first. You'll pay tax on it in your personal name. And then you personally can pay that money to your superannuation fund and claim a tax deduction on the amount you've paid, effectively claiming back the tax your employer has paid. So mathematically, you're in the exact same position as if you have just salary sacrificed that amount directly into superannuation. To do this, you need to notify your superannuation fund that you intend to claim a tax deduction for the amount that's paid to them. Now, this form is available on the ATO website, and it's also available on your superannuation fund's website. And the money has to actually have cleared to your superannuation fund prior to 30 June. So you can't leave it until 30 June to make the payment because the funds won't have cleared to your superannuation fund in time. Now, the important thing to note here is that there are caps and limitations with how much you can put into your superannuation and claim tax deductions for them. These limits are on the ATO website. Whatever you do, make sure you don't go over these limits because you can be penalized pretty heavily. Now, from 1 July 2027, the capital gains tax rules are changing. So if you sold crypto, shares, or other investments prior to 1 July 2027, you are still under the old rules, which is the 50% capital gains tax discount rules. Basically, how these rules work, if you bought an asset and you held it for longer than a year and you sold it and made a profit, then you essentially only get taxed on half of that profit under the 50% capital gains discount rules. If you bought an asset prior to 1 July 2027 and you sell it after 1 July 2027, then you're in these transitional rules where a portion of the gain uses the 50% CGT discount method and another portion of the gain uses this indexation method where you basically reduce the gain by inflation every year. And if you bought and sold an asset after 1 July 2027, then you're in the new indexation rules. Now, depending on when you're watching this video, if you are close to the end of a financial year and you review some of your investments and there are some stinkers in your portfolio, and this is a big and, your investment thesis has now changed, meaning the price is not just down at the moment, but you perhaps think that you were wrong in your investment thesis about this investment. You got it wrong. It's just a stinker. It's not going to do any better. Then what you can do is sell that investment to realize a capital loss. Now, that capital loss can only be used to reduce capital gains or capital profits you make on sales. But the good thing is if you can't use it straight away, you can carry it forward to future years to use. Now, a tax office target area are what are called wash transactions. So if you sell a poor investment on 30 June to realize the capital loss and buy back the same stock the very next day, the tax office does not look too kindly on that. And they call that a wash transaction, which is a target area of the tax office. Now, one of the big target areas of the tax office is rental properties, and especially holiday homes. And the reason for that is they are finding lots and lots of errors in the tax returns of people that have rental properties. And one thing that they are targeting are when holiday homes are not genuinely available for rent. And when that happens, some of your tax deductions may get denied. So a tip here is make sure you have really good records showing all the rental listings of when you had the property available for rent. And here are some of the common tax deductions available for people with investment properties. Now, another big focus of the tax office is when items are excluded from your tax return, omitted, you've missed them. Things such as the gig economy. So income from ride sharing, food delivery, short-term accommodation, freelance work. The ATO is getting information from all these platform providers, so make sure you include that information in your tax return. But the upside, when you include that information in your tax return and you include that income, you can then claim tax deductions, provided it meets our 3 golden rules we discussed earlier. So as an example, if you're an Uber driver and you include that income in your tax return, you can then claim tax deductions related to your motor vehicle, which we're going to talk about next. So if you use a motor vehicle to earn income, then you may be eligible to claim some tax deductions related to that motor vehicle. Now, there are 2 methods you can choose from in calculating your tax deduction. The first is called the cents per kilometre method, and for financial year 2026 allows you to claim 88 cents per kilometre travelled up to a maximum of 5,000 kilometres. Now, you don't need to have a logbook under this method, but you do need to show how you've calculated the kilometres that you're travelling. Now, the second method, which can sometimes be more appropriate to people that have a really high work percentage for the vehicle, so people like Uber drivers or tradies, if you have a really high work percentage, then it may pay to do the logbook method. And under this method, you need to keep a logbook for 12 weeks. And the good thing is that that logbook is then valid for 5 years. You keep a logbook of all your private travel and then all your work travel, and that will give you a total work-related percentage. Now, whatever that work-related percentage is, so for example, if it's 80%, then that means you can claim 80% of all your fuel costs for the year and other vehicle running costs. I'll put some commonly claimed tax deductions up on the screen for motor vehicle related costs, but the key is whatever that work related percentage is, you can claim that percentage of a tax deduction to these costs. Now, I hope these tips will help you avoid tax office scrutiny. In fact, make you feel a little bit more calm should you receive that dreaded phone call. If you enjoyed the video, please give it a like. If you want to see more from me, why not consider subscribing to my channel? Before you go anywhere, make sure you check out this next video. Please keep in mind, I'm not a licensed tax advisor. This video is for educational and entertainment purposes only, based on publicly available information. Make sure you seek the help of a professional in managing your tax affairs.